Did you know that a significant percentage of individual investors fail to achieve their financial goals? This often stems from a lack of planning. Many dive into investing without a clear roadmap, leading to costly mistakes. A well-defined investment plan is crucial for financial success. It's the compass that guides you through the complex world of investing. Understand your goals, risk tolerance, and options to create a strategy. A solid plan helps avoid emotional decision-making. Market fluctuations can lead to impulsive decisions. Stay disciplined and focused on long-term goals. Build a secure financial future, one decision at a time. The importance of investment planning cannot be overstated. It is the cornerstone of achieving your financial goals, whether it's buying a house, retiring comfortably, or securing your children's education. Without a clear plan, your financial future remains uncertain, subject to the whims of the market and unforeseen circumstances. Investment planning requires a personalized approach that considers your individual circumstances, including your income, expenses, risk tolerance, and financial goals. This tailored approach ensures that your investment strategy aligns with your specific needs and aspirations. The process of creating an investment plan involves several key steps, starting with defining your financial goals. These goals provide the foundation for your investment strategy, dictating the types of investments you choose and the time horizon for your investments. Once your goals are established, you need to assess your risk tolerance, which determines how much volatility you are comfortable with in your portfolio. By following these steps, you can create a comprehensive investment plan that sets you on the path to financial success. One common challenge in investing is the lack of knowledge and understanding of financial markets. Many feel overwhelmed by the complexity of investment products and strategies. Overcoming this requires learning and seeking professional advice. Educating yourself and seeking guidance can empower informed decisions. Another obstacle is the fear of losing money. Investing involves risk, and potential losses can be daunting. Understanding risk tolerance and diversifying can mitigate losses. Start investing today, even with a small amount. Setting clear and specific financial goals is the first crucial step in creating your investment plan. These goals provide the direction and purpose for your investment strategy. Without well-defined goals, your investments lack focus and may not align with your overall financial aspirations. Your financial goals should be specific, measurable, achievable, relevant, and time-bound. For example, instead of a vague goal like saving for retirement, a SMART goal would be saving $500,000 for retirement in 20 years. Consider different time horizons for your goals. Short-term goals, such as saving for a down payment on a house, require a different investment approach than long-term goals like retirement planning. Prioritize your goals based on their importance and urgency. Understanding your risk tolerance. Navigating the investment landscape. Understanding your risk tolerance is essential for creating an investment plan that aligns with your comfort level and financial objectives. Risk tolerance refers to your ability and willingness to withstand potential losses in your investments. Assessing your risk tolerance involves considering your emotional and financial capacity to handle investment volatility. Are you comfortable with the possibility of short-term fluctuations in your portfolio's value, or do you prefer more stable investments? This self-assessment is crucial for determining the appropriate asset allocation for your portfolio. Different investment options carry varying levels of risk. Stocks, for example, generally offer higher growth potential but also come with greater volatility. Bonds, on the other hand, tend to be less volatile but offer lower returns. Regularly reassessing your risk tolerance is crucial for ensuring that your investment plan remains aligned with your current circumstances and comfort level. Building your portfolio. Choosing the right investments. Once you have defined your financial goals and assessed your risk tolerance, you can begin selecting the specific investments that will comprise your portfolio. This process involves choosing a mix of asset classes, such as stocks, bonds, real estate, and commodities, that align with your overall investment strategy. Diversification is key to mitigating risk and maximizing potential returns. When selecting stocks, consider factors such as the company's financial performance, industry outlook, and management team. You can choose individual stocks or invest in mutual funds or exchange-traded funds, also known as ETFs, that provide exposure to a diversified basket of stocks. Bonds offer a more conservative investment option, providing regular income payments and lower volatility than stocks. Real estate can be a valuable addition to your portfolio, providing diversification and potential for long-term appreciation. Carefully analyze market conditions and property valuations before making real estate investments. Diversification, spreading your risk. Diversification is a fundamental principle of sound investing. It involves spreading your investments across different asset classes, sectors, and geographic regions to reduce your overall portfolio risk. By not putting all your eggs in one basket, you can mitigate the impact of any single investment's poor performance on your overall portfolio. Diversification can be achieved by investing in a variety of asset classes, such as stocks, bonds, real estate, and commodities. Each asset class has its own unique risk and return characteristics. By combining different asset classes, you can create a portfolio that balances risk and potential reward. Within each asset class, you can further diversify by investing in different sectors. Geographic diversification involves investing in companies or assets located in different countries or regions. The personalized advantage, tailoring your investment strategy. A personalized investment plan offers a significant advantage over generic investment advice. It takes into account your individual circumstances, financial goals, risk tolerance, and time horizon, creating a tailored strategy that aligns with your specific needs. This personalized approach maximizes your chances of investment success. Generic investment advice often fails to consider your individual circumstances. What works for one person may not work for another. By aligning your investment strategy with your personal goals, a personalized plan ensures that your investments are working towards your desired outcomes. Whether your goal is saving for retirement, buying a house, or funding your children's education, a personalized plan can help you achieve those objectives. This tailored approach ensures that your investments align with your comfort level, staying the course, monitoring and adjusting your plan. Creating an investment plan is not a one-time event. It's an ongoing process that requires regular monitoring and adjustments. Market conditions, life events, and changes in your financial situation can all impact your investment strategy. Regularly review your portfolio's performance and compare it to your benchmarks. Are your investments meeting your expectations? Are your asset allocations still aligned with your risk tolerance and financial goals? These periodic reviews help you identify any necessary adjustments to your plan. Life events, such as marriage, childbirth, or job changes, can significantly impact your financial situation and investment needs. When these events occur, reassess your financial goals and adjust your investment plan accordingly. Stay informed about market trends and be prepared to adjust your portfolio as needed. The power of patience in investing. Patience is a virtue, especially in the world of investing. Building wealth through investments takes time and discipline. Avoid the temptation to chase short-term market trends or make impulsive decisions based on fear or greed. A long-term perspective is essential for achieving your financial goals. Market fluctuations are inevitable. There will be times when your investments decline in value. However, panic selling during market downturns can lock in losses and hinder your long-term growth potential. The power of compounding is a key benefit of long-term investing, unlocking your financial potential. Creating a personalized investment plan empowers you to take control of your financial future. It provides a roadmap for achieving your financial goals, mitigating risks, and building long-term wealth. By following the steps outlined in this essay, you can unlock your financial potential and create a secure financial future. Remember to regularly review and adjust your plan as needed. Your financial situation, goals, and risk tolerance can change over time. Staying flexible and adapting to these changes is essential for maintaining a successful investment strategy. Don't be afraid to seek professional advice. Start your investment journey today and unlock your financial potential.